Right, guys, hello. Welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. I'm sitting down for this one because I'm very excited. We're talking about one of my favorite, what I think is my particular favorite opportunity out there in the marketplace. So we're going to do something a little bit different today and go through why I really think that MEG Energy is one hell of an opportunity and why I'm investing in it in a multitude of different ways. If you haven't already liked and subscribed to the channel, I'd greatly appreciate you doing so. And if you want to check out the work that I do on eToro, that's publicly accessible. You can look at that. I'm a popular investor on eToro using a hedge fund strategy of long, short. We're quite defensive at the moment, given market positions. And I also run an options trading book. That's my passion, where I spend most of my time. But I enjoy doing these as a kind of a creative outlet to put my thoughts out there into the world and get some great comments and feedback. So with that disclaimer, just remember, this is just what I think. These are my calculations, my estimations. They may not necessarily be right. They may not necessarily come to fruition. And even if they are right in that sense, that doesn't mean they're right for you. So please do your own due diligence. But I'm going to talk today about MEG Energy. So I'll leave a little link in there to a great write-up I found that confirmed a lot of what I was thinking around this particular energy space in terms of Canadian oil and sands. What is the investment thesis? So in a nutshell, I've spoken about this ad nauseum, so I'm not going to go into it in any detail other than to list out the points very clearly, and you can go and watch some of my previous videos for further explanation. We've got a chronic underdevelopment in oil and gas that's led to a supply dearth. Point number one. This supply dearth is not transitory and will need to be addressed. Future purchasing demand is assured through the refilling of the SPR, which has been emptied a million barrels a day so far, and returning of consumer demand. So people are getting back out there, getting in their cars, going on planes, doing normal stuff, heating houses, cooling houses. The thing with energy is the demand is inelastic. It just tends to go one way. Yes, it can come back a little bit with recession, but it's an essential function of life. Energy is life. Inflation-adjusted return of WTI, okay, to its all-time high is now around about $184 WTI. So previously, in the previous cycle, oil got as high as, it didn't quite hit 150, so high 140s. If you inflation adjust for that, that would suggest an all-time high in today's inflated dollars of around $184. So we've got a long way still to go, potentially on the upside, guys. Canadian oil and gas producers are the most ESG friendly in the sense of, you know, they do put a hell of a lot into their corporate governance. Eric Nuttall talks a lot about how they moved a whole heap of plant and equipment, basically moved an entire production site because there were a couple of anthills that were going to be disrupted. Okay, so they do think about the environment. They want to be ESG friendly, even though ESG is, as far as I can see, quite the racket as opposed to a genuine and beneficial movement. But anyway, we'll leave that discussion for another day. And so I believe the Canadians are in a great position to profit because of this, and also because of the Forex delta. So what I mean by that is that these guys sell oil, which has to be priced in US dollars. That's Uncle Sam's control over the world, I guess. Their expenses, however, in Canadian dollars, which are slightly softer. So if you have a strengthening US dollar, which we do, and you have, by definition, the Canadian dollar is a little bit weaker, you have a margin expansion for these producers. In addition to the fact that their revenues are increasing on increased oil prices. Most producers are discounting around about $65 WTI, which is a huge margin of safety, guys. That's why I put that there. With oil well north of 100, that's a huge disparity. Boards are promising to prioritize return of capital to shareholders over Capex. What does that mean? It means that instead of, in the good times now, for these guys with oil over $100, normally you'd see a whole heap of producers rush to increase their production. These guys have learned from the shale boom of 2014 when oil went through the roof. Every man and his dog jumped on board and started to dig up oil any which way they could. They flooded the supply. they flooded the market with the supply, and so naturally the price came down. This time around, we've got such a decreased supply to begin with. We've got huge pressures on the shale basin. We believe that the best of the basin has already been dug up. And so though you don't have this huge bazooka in your back pocket in terms of supply being able to come online from the shales, because they've, to most people's estimation, high graded their production, meaning they've taken the best, easiest wells, and it's going to be much harder to bring on more production. It's not going to be like 2014. So these guys are not plowing capital back into growing their production. They are paying down debt, number one, and then they're going to return their capital to shareholders, number two. They've stated that many, many different times, multitude of different Canadian companies. So the fiscal discipline is quite high, which is great for two things. One, as a shareholder, that's what you want to see. You want to have return of capital quickly and a high rate of return on your invested capital. But also it suggests that there will be this kind of put underneath the, or floor put underneath the price of oil. If you don't have a whole heap of demand coming online, where's the supply going to come from to get the price relief? So we, in my estimation, I think we're going to see oil higher for longer than most people expect. I think it's going to take quite a bit of time up towards the $180 mark, maybe even more, before we hit demand destruction, which will allow the price to cool off a little bit. And even if we do get demand destruction with the Fed raising rates, where's the supply? It doesn't fix the supply side of the equation. So these guys are printing huge amounts of free cash flow, and I'm reasonably confident now to start my modeling based on $100 WTI, which you're going to see in a second. So why MEG? MEG is a little different. It's not available on eToro. It is a TSX listed company. They're a producer in the Athabasca Basin, okay, oil sands. They sell, they don't sell a lot of sort of crude Brent WTI. They sell AWB, which is a little bit less value than WTI, but I'll adjust that for thousands of barrels of oil equivalent per day, which is based off the WTI price. They have over 2 billion in proven and probable reserves. So a huge production base off which to work, which I believe will be very, very valuable in the future. Producing roughly 96,000 barrels a day oil equivalent, okay? So roughly, if you look at that, you say they've got about a 50-year production life if they don't increase the pace of per day production, which they could. Sustaining Capex is around 390 million. At a cost of production about $30 Canadian per barrel. Okay, so at $100 US WTI, these guys have got huge margins. Management, this is a really key point. Management has left its production unhedged. So this particular company has huge leverage to the oil price. It's basically a call option on oil without an expiration date. So they got a 50-year production life. They haven't hedged in their production. That's the one thing that really, if you're a commodity producer, you're going to go through cyclicality. That's the nature of the game. But if you hedge in your production, and yes, I understand you need to do that at times to get financing for your production. If you hedge too much at lower prices, you get to this situation where you go through the hard times, you get to the good times where your commodity price is soaring, but you've hedged your production. And if oil is trading for let's just say $150 WTI, and you've hedged in your production at 80 or 90, you're missing out on that gap. This is the opposite situation with this company. Okay, so they're more exposed to the oil price whether it goes up or down. In this case, we have strong opinions about the future of oil price, and it's essentially a call option without an expiration date that will pay you dividends that has a 50-year potential production life. So very, very attractive for my way of thinking. They also have another little kicker, which embedded tax benefits. Okay, so they've had prior losses and write-downs from the past, which they can carry forwards. And depending on who you listen to or who you look at, that is worth somewhere around $3 to $5 per share. Okay, so it's trading at roughly $21 last I looked, Canadian. So you got maybe $3 to $5 worth of value, which is 7% or thereabouts worth of value purely in the tax benefit. They have lots of different wells, and so you also have the optionality on that future well development. That 96,000 a day is from their main development. Okay, keeping things simple, and I'm getting a bit too carried away. I know. I'm going to slow it down now. Back of the envelope, let's just keep things super simple, super basic. Enterprise value today, 9.2 billion Canadian. Free cash flow estimated at by the analysts, estimated at 1.8 billion Canadian. So with an assumed price of $65 for barrel of oil, you get a return of your invested capital in 5 years. So you're paying roughly 5 times the free cash flow, which is not bad at all, especially then when you consider 45 years worth of ongoing production and associated cash flows from that. Now, the real kicker is when I go in and I change the model because I want to model this at $100 WTI because I believe that's going to be there for a while. Then you get an enterprise value to free cash flow of less than 3.85 as of 2023. It'll be probably less than 3, okay? Because you're buying it in, let's say, nearly June, and so you're getting 6 months worth, okay? Analysts estimate the 2022 revenues at 4.8 billion US, okay? I've changed it to keep everything consistent. At 96,000 barrels of oil equivalent, it's implying about a $69 WTI price. Okay, so you just look at the revenue expected times by the amount of production expected, and that'll give you an idea as to what the market's discounting. So the market is discounting $69 WTI for this company. But as you can see, I disagree. And I feel reasonably confident modeling this out at 100. And obviously, you can do your own sums and see what you make of it. With the net debt, okay, so let's talk about management. With the net debt up to 1.2 billion, so if they pay down at current rate roughly 600 to 700 million, the company will then deploy 25% of its free cash flow to share buybacks, and the remaining 75% to debt reduction. So it's good fiscal discipline. Their stock, they believe, is cheap and they're buying it back. So that's a good vote of confidence and great for us as shareholders. There's less remaining shares. Our claims on the cash flow increase. 75% debt reduction. Okay, very pragmatic. From there on, so once they hit 1.2 billion in debt to the point where they're at 600 million in debt, 50% of the free cash flow will go to buybacks and 50 to debt reduction. Now, I don't know if it's entirely buybacks. I want to seek clarification. It might be dividends and buybacks, I would imagine, because there's a law in Canada, as far as I'm aware, a company cannot buy back more than 10% of its float in any one given year, okay? And if this were all to play out, I think they would be buying back about 17% of the float, which I don't think would be allowed. So they'd have up to 10%, and then the rest of it they'd kick over probably as a dividend, I would imagine, at this point. The reason is because once they hit 600 million in debt on their debt level, that's net debt, 100% of the free cash flow is given to the shareholders. Okay, that's exactly what, I don't know about you, that's exactly what I want, okay? Commodity producer, invest in your Capex, sure. Keep your production growth at a manageable rate, okay? Do not jack up the business to the eyeballs with debt so that you can pump out as many barrels as you can. No. Printing cash, fine. Pay down your debt, survival first, and then give me back that cash at a high rate of return on invested capital, and I'll be a happy shareholder. So let's look at 2023, the estimated free cash flow, 2.3 billion, divided by at least at today, so not factoring in further buybacks, 310 million shares on issue. So that's around about $7.42 per share. Add in the tax benefits of maybe $3 a share, and you're talking $10 roughly, a bit over $10 worth of value, maybe more. So you're talking sort of twice the cash flows of next year of 2023. Okay, it's ridiculous yield. Free cash flow yield, and then possibly 20% of which will be in dividends. As I say, depends on how much they're allowed to do in the way of buybacks. Either way, we don't mind. We like buybacks, probably prefer buybacks depending on your tax situation. But hey, life is pretty good at this point. Then you've got, as I mentioned, the $3 to $5 a share in tax benefits. Okay, screen grab here of the main inputs, and then I might even take you to the rest of the spreadsheet that I use, and you can obviously do a similar thing yourself and change the inputs. So Tax rate, that's all very straightforward. Discount rate of 20%. Why so high? You know why, guys, because I need that as my IRR for me to want to take the risk of investing in capital markets. If you're one of the equity risk premium guys or capital asset pricing model guys, and you looked at it and said, what's the risk-free rate is around about 3% at the moment on the 10-year. What's an equity risk premium? Inflation's at 8%. So, I don't know, you want at least another 8%. 3% plus 8% gives you 11%. I don't know. I want more, or else I'll just wait for a better opportunity. I can make more in the options market, for example. So anyway, before getting sidetracked, EV to EBITDA multiple 8 times. Now, that is not what I'd normally put for an out of favor sector like the fossil fuel energies. Why is it so high? Because normally when you're putting it 4 to 6 times, that's implying a production where you've got maybe 10 to 15 years left with a 30% decline rate. That is not applicable to this company. They've got 50 years worth of reserves. Their decline rate is much lower much lower than that. And so then you throw into the fact that if someone were to acquire this company, maybe Cenovus, for example, or Canadian Natural Resources, they would also get the benefit of those tax pools. An 8 times multiple is very reasonable. Okay, so normally I wouldn't go to 8. I modeled Cenovus on 4, for instance, but I think it's certainly applicable in this scenario. The rest you can all work out. You can get your information from the SEC or wherever you like to get your information from. And here we have the models of the cash flows at $100 barrel equivalent, which you'll see. Now, let's take a look. Initially, in this first year, D&A is high. Why? Because we're trying to go from sort of 1.7 down to 6 million in terms of the debt. So out of the EBIT, they're going to take some of that and they're going to push it back into debt reduction. Okay, so that's why it looks different from year 1 to the next year. The next year, I've just used the simple average because they've said once they hit 600 mil, they will continue to just kind of hold that debt and make the interest payments whilst they return capital to shareholders. So I would imagine that their D&A would remain at the average that it has been and remain fairly constant. You may disagree, and obviously you can change that in your own models. Capex, this is what the Capex has been. I modeled in a 10% growth in Capex, which I don't expect whatsoever. Here's the unlevered cash flow, and then you can see the growth rates. You can apply your own growth rates to the EBIT or to the Capex. That's probably overly pessimistic in terms of the Capex. That's what I would say. When you look over here, it's saying we've got a suggested intrinsic value of about $51. Somewhere around $50, I think, is easily, I shouldn't say that. I curse myself. I jinx myself. We'll say it's reasonable to assume $50 as a target for the value of this business when you take everything into account. So let's see if we've got an upside of a 2-bagger, maybe a 3-bagger, the IRR of which would be 52%, which is obviously phenomenal. Down the bottom here, the only other thing I want to draw your attention to is my little matrix. All I've done here is look at the expected production and the price. That'll give you expected revenues, and I've used the 30% EBIT margin. The company's history has a margin much higher. I've been very conservative and used 30%. So that's where I get the EBIT from. It's up to you how you want to look at it. Tax bills taken from the annual report here. They've got 5.2 billion that's deductible. An acquirer would get that as a benefit. So as you see here, amount used per year and what that looks like if you wait out several years and discount it back at a rate of 8%, what that means in terms of value as a Canadian dollar per share. So they said here somewhere around the $4 mark would be reasonable in terms of an acquirer looking to buy the business for $21 a share. Automatically, they'd be getting $4 worth of value purely from the tax pools, and then they would look at potential cash flows that they would get. And obviously they'd try and get cost synergies and all that sort of thing to reduce expenses and widen their margins. All right, guys. So thanks for watching. If you haven't already liked and subscribed to the channel, I greatly appreciate you doing so. If you've got your own comments, what's your favorite stock? Put it in the comment section. I'd be very interested to read. If you're interested in copying the portfolio, if you like the style of investing, you may wish to copy the portfolio on eToro. Simply download eToro and click on the link and away you go. And otherwise, add me to a watch list and you can see what I get up to. Disclaimer time. As you guys know, this is not advice. Anything on this channel is just my opinion and what I'm doing with my personal money and the money that I look after. Doesn't mean it's right for you, doesn't mean it's going to be right at all. Okay, so you need to see your own personal financial advisor and you need to take responsibility for your own decisions. Having said that, I hope that you enjoyed the video and I look forward to seeing you in another video shortly. If there's anything you'd like me to cover, put it in the comment section and I'll do my best to get around to it.